Hello and welcome to this week's Query of the Week. So this week there's just I suppose a few queries, a few misconceptions in relation to the treatment of various things. So I just said I'd give you an example of some of the things that have come across the desk over the last whatever 3-4 weeks. Just I suppose one of them was in relation to agricultural relief in Section 89 for the purpose of capital acquisition tax. In order for crops to be considered agricultural property for the purpose of relief, they must be growing. If they're not growing, well then they don't come within the definition of agricultural property, and so therefore when you're doing your 80% test, they'll go into the non-allowable elements. So it's just want to watch in relation to that. Another one that maybe that's recently is in relation to the principal private PPR in relation to Section 89 as well. So where when you're doing your farmer test, looking at the 80% test, if you have a mortgage on your principal private property, that can be used to reduce the value of your principal private property when you're looking at your farmer test. But it's important to remember there that if you remortgage your property, it doesn't apply. It cannot be netted against the market value of the property. So that's just another reminder that I think is useful for practitioners. Another one I suppose that's relevant as well with entrepreneurial relief. Let's say, what if you've sold assets and entrepreneurial relief applies at the 10% rate, and you've a gain on it, 10% applies, and there's losses brought forward. What way does that 10% or that gain does it have to be utilised against the losses forward, which could have been losses forward where it was 33%. So Section 546 deals with with what you said against losses forward first. So let's say in the example, what you would let's say you have two gains made in the year, in the CGT year. One of them at the 33% rate, one of them at the 10% rate. What ones do you use first against your losses? Section 546 is clear that you use the higher rate first, so you use the gain on the tax at the 33% rate against the losses forward, and then afterwards you'll use the gain on the entrepreneurial relief. So obviously it's better if you can structure deals, so if you are going to have a gain on entrepreneurial relief at 10%, that you would try to also maybe make a gain at the higher rate so that you can get better use of your losses. But I suppose it's not always that simple. You don't always have the ability to transact like that, but it's a nice one to know, and it will become more relevant as entrepreneurial relief is in since 1st January 16. So effectively, in short, what it means is that if you have a CGT loss going forward, it can be set against entrepreneurial relief, but if you have a gain at the entrepreneurial relief and a gain at the 33% rate, the losses forward will be utilised against the gain at the higher rate first, which is good. The final one then is just the importance of, when, in particular circumstances where there's a difference between one company and another company. There's an election called a Section 4343A election, whereby when the election is made by both companies, the dividend that's paid by the company that makes the dividends is ignored for the calculation of closed company surcharges, and then the company that receives it is ignored for the calculation of the closed company surcharge. So in effect, it works very well where there's trading, where the lower company is a trading company and it doesn't have any estate or investment income. But the point that I'm making here is, you may, in order to get the benefit of the Section 4343A election, you actually have to make the election in the corporation tax return for the period that it relates. If you don't make the election, well then it's not ignored for closed company surcharge purpose in the whole co, and you have a closed company surcharge calculation then if a dividend isn't paid within 18 months of the year end for the whole co. So just the importance again is get the timing right. If you're making the election, make sure you tick the box. By the return deadline, has to be done by the return deadline. Otherwise, the election is ignored, and effectively you're into a closed company surcharge in whole co in that particular example. So I hope you find some of these nuggets worthwhile. There's a webinar coming up on the 6th of March called the Common Tax Errors and Reminders. So there'll be a lot more nuggets in relation to that, which I think you can benefit from. Thanks again for listening to me.